Lots of events, lots of things to talk about. Therefore, please welcome your host, Chris Peterson, with MedianReport.
The mood of investors and entrepreneurs. We all want to understand the direction it's taking. That's why we are looking into three separate events: a CFO forum organized by SEB Bank, a foreign investors high council meeting in Riga, and private investors conference, again in Riga, to measure the temperature in a hospital. For those who want more, we will be allowed to have a sneak peek in the real Illuminati meeting 3 weeks ago in Saudi Arabia. Anyway, my name is Chris Peterson. This is MedianReport from Riga, Latvia, and we will talk. Let's first have a look at our economies, how they were doing in October, and then I'll have a look into tomorrow as well. At least all Baltic countries, when it comes to inflation, are in 4 to 5% territory. Estonia reached a good target, easing consumer prices from 5.2 to 4.6. Lithuania moved up from 4.0 to 4.1. Latvia the same, from 4.0 to 4.3. Let's start with Estonia. The good news is that the economy has returned to growth. The rather bad news is that the growth is very modest, just 0.6%, according to ST Bank. Positive sections: ICT, manufacturing, real estate. Not so positive trends: the domestic demand is still under pressure, plus tax increases are squeezing private consumption and dampening business investment. External risks remain significant as the outlook for exports is fragile. If we compare to the neighbors, Estonia's weak domestic demand and tax burden highlights the regional convergence is far from assured. Latvian economic sentiment has improved. On the other hand, some sectors reported stronger business environment, including construction, retail trade, and services. OECD indicated that public investment via EU fund inflows and spending should help underpin the domestic demand. On the negative side, though, Latvia goes through very modest GDP growth. Fiscal wiggle room is very tight, and although Fitch agency gave back Latvia the A- rate, the government debt for next and following years remain a subject to watch. Well, what about Lithuania? Everyone prizes Lithuania. We can only repeat that from all three countries, the southern neighbor has solid, resilient growth trajectory. Lietuvos Bankas projects growth of 2.9% this year and solid 3% next year. It remains on the top of fastest growing countries in the whole European Union. Although the consumer confidence remains moderate, real wage growth and relatively favorable labor market help underpin the domestic demand. The new government has actively started several reforms and has proposed a rather bold and courageous state budget for the next year. If we touch on some negative perspectives, then I would be cautious about investment growth. Also, the labor market long-term scenarios, they seem foggy. To be honest, 3% growth still counts as moderate, not a boom. Few external winds in wrong direction and the game can turn. All three countries, but especially Latvia and Lithuania, lack more aggressive reforms in public sector, education, financing, science, and research and development. The problem is that the short-term homeworks get done pretty quickly, but long-term strategies collect dust under the table. Let's look at the world economy as it's entering a cautious, uneven phase, a mix of relief and restraint as inflation cools, but growth stays fragile. Central banks have paused aggressive tightening, yet no one is declaring victory, and every rate signal or trade headline now carries outsized influence. The global picture is neither crisis nor a boom, but a delicate balance between moderation and momentum. Across major economies, data show a patchwork recovery. U.S. job openings have dropped to 3-year lows, while layoffs rise. Europe remains subdued as Germany's industrial slump drags the region. The UK flirts with stagnation, and China's weaker than expected exports confirm that its post-pandemic rebound has faded into a slow grind. Inflation remains about target almost everywhere, keeping rates higher for longer. Trade flows reflect the same mixed tone, modestly rising shipping volumes, but a clear shift toward regionalization as supply chains diversify away from China toward Vietnam, India, and Mexico, while Europe pushes for localized energy and semiconductor capacity. Services are holding up, but manufacturing sentiment is pretty flat, with October PMI data showing export orders contracting in nearly half of industrial economies. The one ambiguous engine of strength is technology. AI infrastructure is spending and it's exploding, with NVIDIA, AMD, Microsoft, and Amazon driving a wave of data center investment that offsets weakness in housing, construction, and consumer durables. Analysts see that the early contours of an AI productivity wave, though the question remains whether gains will reach the border economy fast enough. Geopolitics and regulation continue to cloud the outlook. US-China rivalry, tariff disputes, and Middle East tensions raise global business costs, while the IMF warns trade fragmentation could cut long-term GDP by 2.5 percentage points. Energy markets have stabilized but remain vulnerable to supply shocks. Financial markets mirror the caution. Elevated equity valuations alongside bond investors pricing slower growth, with US 10-year yields slipping below 4.1% and gold nearing record highs. Bitcoin has cooled as profit-taking hits the speculative edge of AI crypto trade. Corporate earnings remain resilient but show narrowing margins. Regional divergence is stark. Emerging markets face tighter financing. Asia is buoying by India's rapid growth and Japan's industrial revival. Europe struggles with consolidation and political tension. For Baltics, Nordics, and Central Europe, the focus is on reshoring, energy transition, costs, and new competitiveness drivers. Policymakers now need structural thinking over stimulus, while companies prioritize selective investment in AI, sustainability, and resilience. The global economy is still moving, but slowly powered more by adjustment than momentum. There are some interesting news lately on Baltic corporate horizon. First, the Central and Eastern European Top 500 has been published. 5 companies from Latvia, 9 from Estonia, and 25 from Lithuania have made the list this year. We see that industries that shifted their focus from Eastern market to the West have lost their momentum for a bit, allowing service industries to climb the ratings. Lithuania showed a variety of its businesses and its business structures, like, for example, growing startup ecosystem and strong retail trade company consolidation. Poland still leads the rating with 178 companies in the top, leaving Czech Republic number 2 and Hungary in the 3rd place. Number 1 is in the list still remains Orlen, the state-controlled oil, gas, fuel, and energy group. SEB's latest Baltic CFO survey shows sentiment stabilizing after 2 turbulent years. Most CFOs describe current conditions as average, with easing inflation and lower energy prices supporting a gradual return of confidence. Investment plans are cautiously resuming, focused on efficiency and digitalization. Still, executives flag rising costs, weak external demand, and geopolitical uncertainty as the main risks limiting stronger recovery. To tell us more, MedianReport invites the head of corporate banking at SEB Eesti, Mr. Peep Jalakas.
This year, more than 300 large corporate CFOs responded to the survey, and I think the one general finding is that the optimism increased in Estonia and stayed rather stable, but on a high level in Latvia and Lithuania. So if we go back to the last year, then Estonians were clearly the biggest pessimists in Baltics, but we are catching up Latvia and Lithuania fast.
Yes. What was interesting for me is that each country were asked to evaluate its own development and success, and also neighbors. And I don't know why, but the Balts have this constant tradition to value their neighbors higher than themselves. Why is that? And did we see the same result this year?
Correct. What we asked this year was that how do the CFOs see the foreign investment environment in Estonia, Latvia, and Lithuania, and then what are the reasons that if they choose, let's say, Lithuania, that what are the strengths of Lithuania? And overall, in all countries, actually, Lithuania was the favorite direct investment destination. No, reasons behind it are I would say different, but one common reason is that if we look at the economic growth today, then Lithuania stands out, and it is partly related also to the trading parties and partners of different countries. If Estonia is more open to the trade with Nordics, then Lithuanians are benefiting from the growth in Poland. But what was really interesting is that the assessment on the political stability and also the tax environment was very diverse, meaning that actually local CFOs were rather skeptical about their own country tax environment and political stability, but were praising the neighbors, and then that was the same in all countries, meaning that it seems that the grass is greener on the other side of the country border. So. Or we are very demanding then towards our own states and governments.
That's true. That's true. Also, I know that every year there are heated debates about availability of capital and how banks are performing and everything. So this, how would you characterize this discussion?
Yes, what is specific for the Baltic states is that we are small economies, and the banking sector as such is playing a crucial role. And if we asked about the availability of funds and what is the preferred source of funds, then bank debt stood out very strongly. So close to 90%. Indicated that if they need some funding, then the bank debt would be the preferred solution. So no, but this is something that was also expected. Our capital markets are rather strong. Sorry, are rather small.
Small, yeah.
Small, and also if you look at the debt capital markets or bond issuance, then many counterparties are actually too small to issue a euro bond in European market. Yes, we see some activity in local Baltic level as well, but in overall terms, it still contributes rather little. if we ask that what is their expectation and how to get the investments going again in Baltics or increase the investment capabilities amounts, then one clear topic that stood out was the overall tax environment and the certainty that also local governments provide to us. And I think that is absolutely crucial in today's environment, where the external uncertainty when it comes to the trade wars, geopolitical risks, now these are on a very, very high level. So as much as can be done by the local governments should be done, and I think we have seen improvement here, even if not all the tax raises are already in place. At least the decisions are made, and the expectation from the entrepreneurs and CFOs is that this tax piece is something that they aim for, and then that creates the good platform to take new investment decisions.
Yes. I know that in the survey there is one specific angle each year which has been discovered maybe more. In the past we have talked about sustainability, we have talked about artificial intelligence. What was this year's special angle?
This year we focused on resilience and also asked about the different initiatives and areas where CFOs see that the government should head, and actually what really stood out was that I think that there is a consensus in all countries that the overall defense investments, where we have seen that all countries are heading towards 5% of GDP. This is something that is really important. Also, Rail Baltic as a Pan-Baltic initiative stood out, and then the final part was the energy security and also affordability, and there were two parts. One was renewable energy investments, but we also asked about the nuclear potential new nuclear plant in Baltics, and here the Estonian and Latvian CFOs were more favorable towards this initiative. In Lithuania, I think that there is the background and history all related with Ignalina, so they were more conservative about the potential nuclear power plant establishment in Baltic. So the resilience was the common theme this year.
Mm-hmm. If you can maybe elaborate a little bit on the two things, renewable energy and also Rail Baltica, which is interesting for me to and also for listeners maybe to understand how CFOs look at these two areas.
No, we didn't go into very much detail, but I think that what we have understood in this geopolitical environment is that these common Baltic projects, these are more and more important. So it's not that each country is driving their own investment strategy, but it's more of the region, and if we want to be attractive to the foreign investors, then it's also crucial to offer something more than just 1 or 2 million euro population, small country close to the Russian border, and clearly I think that there has been sort of indications that Rail Baltica can also be seen a bit as a military project, or at least it increases our connectivity to Western and Central Europe. So I think that this is important, and of course, when it comes to the energy, then we are currently energy importers, so we need to build up our own production capabilities, and this is important both from the sustainability angle, but also from the energy security perspective, and also the energy affordability. So today, renewable energy seems to be also the cheapest energy. And if we look at the global trends, AI, different data center investments, we know that there are already projects up and running or planned in Finland. Why not Baltic to be a potential destination for these investments? But for that, we need also reliable and affordable energy. So I think these are the trends that we also identified in this year's survey.
Retail Investors Conference on November 8th, held in Riga, unpacked many interesting features and surprises as the first ever Latvian Investor Pulse 2025 report was published. More than 60% of respondents showed readiness to invest in state-run companies if such offer would be available. Among most attractive tickets, Latvian Forest Company, LMT, and Latvenergo. Survey showed a moderate optimism when it comes to growth of the Baltic markets, leaning more towards bond market, which is more live and active in recent years. I remind everyone that on November 27th, there will be a Baltic Capital Markets Conference in Riga. Everyone is welcome. MedianReport will be there. Come and say hi. My personal favorite presentation came at the end of the event. It was from Tautvydas Medžius, who is the head of strategy at Artea Bankas. He mentioned few hot stocks for 2026, but during the interview, I was more interested in Artea Bank's prospects and place in the Baltic capital markets.
First of all, maybe I'll start with a quick introduction of Artea Bank. It is, a leading financial institution based in Lithuania, the oldest one and the only independent one, meaning that we don't have any affiliation with foreign entities. So we are a national champion, in the market, and we a universal bank, meaning we're serving both corporates, retail customers. There's only 4 banks in Lithuania can do that, and we're probably one of them. We are the only publicly traded company. And, you're absolutely right. When we put together the strategy, we got to think not only about the long term, but also about our quarterly results. So we went to the market and gave an update about our new market back in 2024, after we made an acquisition of IDAL Asset Management Company. As a result, this was like really, really big acquisition for us, and the company's business profile changed, our board of directors changed, our shareholder structure changed a little bit. So we felt, okay, it's time to renew the strategy and tell the world about it. So, what we're trying to do, effectively, we want to be a top 3 player in Lithuania, and, want to be the best bank for all stakeholders, including customers, regulators, as well as our shareholders. We promised them that we're going to deliver at least 50% return over the time. Now, how are we going to do it? Few number of things. In the short term, we're upgrading our technology platform. We're changing old legacy system and moving to new core banking system, which is going to be cloud-based, very advanced, and very nimble platform. That will allow us to roll out new products very quickly and react to the customer needs. So that's number 1. Number 2, we went through a rebranding exercise. Remember, back in the day, we used to be called Bankas. Not the best name if you have a national strategy. So, Šiauliai is the 4th largest city in Lithuania, but we're doing business across the country. not easy to do business in Kaunas or Vilnius when you come and say, hey, I'm from Šiauliai. So we went through this, rebranding exercise at Artea Bank, which went well. Was well received by our customers, and it was a difficult project. Chris, you would think, okay, you need to come up with a new name and that's it. But actually, there's like lots going on. And then, thirdly, what we're doing is we're doubling down on our digital distribution. So when other banks in the country and across this region in Latvia and Estonia are closing down the physical branches, we said, no, we're going to keep them. We're going to refurbish. The future is not only digital, the future is also physical. So that's...
And relationships.
Exactly. Especially when it comes to, to corporate banking, especially when it comes to selling more complex financial products like life insurance, mortgages. People like to come into the branches, sit down, look into the manager's eyes and, discuss it. So we're a little bit contrarian from that perspective. So we're doubling down on the digital. So that's what we're doing short term. It's a new name, a new technology, doubling down on the distribution and refurbishing our branches.
Yeah.
And look.
My question is, and why I was asking about the strategy is you are listed in the stock exchange as in the Baltic list. So it means that also in Latvia and Estonia, people know your brand, but only as a listed company. But how about the visibility in Latvia and Estonia in that sense?
Yeah, so I'll give you a fun fact. We have more Estonian shareholders in our cap table than Lithuania. There's about 11, 12,000 different Estonians invested in our company, only like 5,000 or 6,000 Lithuanians. So, we are a well-known name amongst the investor community, but we do business only in Lithuania for time being, and that's why, we're a little bit less known for people who are not investing. Can we go abroad and expand geographically? Yes, but probably not in the short term, maybe like in the medium term, we could, start rolling out things like consumer credit or collecting deposits in other countries. But at the moment, we're focused on Lithuanian markets.
It's because you feel comfortable? It's because you want to acquire a bigger market share, or you want to grow? Or what is the precondition for you to step outside maybe the national borders?
So at the moment, that's not our primary focus. We think we got enough runway in Lithuania. The economy is big and it's expanding. So GDP is growing faster than in the European Union. So that's number one thing. Number two thing, credit penetration in the country is still very, very low when you compare to the Western Europe. So the credit is growing at like 10, 12%. And thirdly, we think that our Scandinavian peers not doing a great job. They're failing the customer. Swedbank is too big, they're getting complacent, SEB always being complacent. So I think there's like a lot of things we can do in Lithuanian market, sort of what LHV did in the Estonian market, right? So plenty of runway to grow and grab market share from bigger peers.
Yeah, it's interesting that your bank is really taking the place of what LHV is in Estonia, and now Indexo is somehow, or because Citadele is somehow grown out of that league, but it's kind of interesting that this sector is growing as well. You are talking today in an investors conference here about the trends in 2026 in Baltics, and so I want to challenge you to the European level and how you think this common European capital markets idea is coming to realization. What do you see from your perspective, and are you waiting for something like this now?
Well, first of all, it's a great idea. It needs to happen. Full stop. Period. Right? Is it happening? That's a different question. Look, the European Union. The whole idea was built on 4 pillars: free movement of people, goods, services, and capital. I think we did a good job in the first 3 things, but free movement of capital, still there's some work to do. And like capital markets union, it needs to happen. It didn't happen. It's critical for Europe's development. We, as Europeans, way too reliant on banking debt. We need more risk capital in our economy, right? This is how startups come together. This is how smaller companies become bigger companies. We need more like venture capital, equity capital. And typically that's not coming from banks. It typically comes from, exchanges and that ecosystem. And then the other thing, Chris, is when you think about it, like we're falling behind to the rest of the world when it comes to financial services as industry. So maybe you read this interesting article with a catch a headline like London falls out of top 20 IPO destinations, falling behind Mexico. It just gives you a little bit of the flavor, that the world is moving ahead and I think we're stagnating. So we definitely need to put together our resources and start thinking about like things like, okay, maybe instead of having 20 different small exchanges, maybe we'll put together and have like one big exchange, maybe based in Frankfurt, Paris, I don't know. Back in the day, I remember like London Stock Exchange was trying to merge with Deutsche Börse 2016, but the EU commissioner, or was an investigator, said no, like you guys going to create monopoly, and no, we're going to create a powerhouse which will be able to compete with American exchanges, Asian exchanges, and try to bring the capital, more IPOs. So
in that sense, I wanted to ask also about the Baltic listing. So
yes,
do you see that it would make sense that Baltic capital markets would be added to Warsaw or Stockholm, for example?
well, it would be good for Polish stock exchange and Stockholm, but not for us. Not for us.
What the bigger market, bigger capital, bigger investor attention?
Yeah.
Of course, more expensive to do roadshows and such, but still.
So it's funny, like a few Lithuanian companies tried to do dual listing. You remember Novaturas was dual listed in Warsaw and in Vilnius, and I think there was like Avia Solution Group, Avia IM, which tried that. But eventually they decided it's not working. You're splitting liquidity between two venues, and the Polish market is a tough one to crack. Investors still not necessarily looking at you same as domestic companies. So ultimately, people came back to domestic stock exchanges, and it's good. We need companies to stay in our market. We need more IPOs. It's critical, right? I'm thinking about this MSCI index classification, which you probably heard about it, right? At the moment, we consider it to be frontier markets. At some point, we'll enter into emerging market status. Once that happens, there'll be more capital flowing into.
In the last days of October, traditionally, foreign investors in Riga gather for a High Council's meeting with the Prime Minister and ministers responsible for finance and economics. I had an opportunity to talk with the chairman of the Foreign Investors Council. He's also a CEO of Schwenk Latvia, Mr. Reinhold Schneider. I have followed the High Council meetings since 2015, and what I noticed that pretty much each year the council comes out with at least one kind of very serious recommendation and maybe some warnings even. How about this year?
I think this year it was more this general topic that we see a lot of recommendations have been started to execute, but now they got stuck. So, for example, we see still this worrying topic of shadow economy. And last year, the government, Minister of Finance came up, we think, with a very good plan, including quite a few of our recommendations, how to reduce, how to combat shadow economy. And now we see that there were even regulations and law amendments proposed, but they have not been passed in the Saima, and we see that many of them or some of them got stuck. So, and that's a general concern with a lot of recommendations that they got stuck halfway as well regarding energy independence. Some movements have been done, but they got stuck. Recently, there was as well this improvement of construction permits, how to make them faster, and now this has been passed, so we hope that this will continue. But yeah, a lot of good intentions, but execution is lagging behind. That was one of our major concerns.
Mm-hmm. Sometimes it's a people factor, but sometimes it can be also some, I don't know, EU legislation waiting for new rulings coming out from Brussels or something like that. What's the case in this?
No, I think in these areas like shadow economy, we don't have to wait on any European rules. I think this is simply a question of being executed. Because there's always different opinions on some reforms, but here I think it's really a topic how to bring it through the parliament. And in that context, it was also discussed how we can maybe accelerate this implementation of these reforms. And we understood as well from the government that there are many laws and amendments, there's like a queue in these different committees of the SAIMA, and we agreed that some of these laws or amendments which will really make a difference, which would make a huge impact, that they will be now prioritized and that they will be moved to the State Administration Committee in SAIMA, so that this is faster than in other committees in SAIMA, so that is really prioritized. That was one of the agreements we made during this High Council, how to improve this execution. And there we had this as a main topic, so how to keep the level playing field between the public sector and the private sector, also looking at recent developments. As you say, the public sector is growing. There are intentions to grow even more. Topic of PET as well, and then LMT, how this is now discussed. And it was explained by the government, the rationale behind that. But we were telling our concerns that we see the public sector is getting stronger, the state-owned companies are getting stronger, but some regulations are missing. And again, there are some amendments. This law 88, I think it's in this, which has to be passed. This is regulating the governance of state-owned companies, so this is also lagging behind, but we understand it should be passed now. So that there is a clear governance of the state-owned companies, what they can do, what they should do. If they are really acting like a private company, then they need to follow similar rules or the same rules, so that is like a level playing field. So that's what we emphasized once more, that we are concerned with that the public sector is growing. Oh, we saw in this sentiment index in spring, when we are always evaluating the investment attractiveness of Latvia, and this year we compared as well to the Baltics, we saw that the investment attractiveness is quite okay. But we see as well that the companies we asked said, okay, despite the fact that its attractiveness is okay, we're investing less than in previous year, and we believe, or we know, that this is due to the geopolitics and concerns which are there. On the other hand, I think we can work, the government and as we as investment council, foreign investment council, we can work on that. We emphasize the security, what we have done as well in this conference in spring, that we are really emphasizing that we believe in the security of Latvia as a investment location. And I think that can be done as well by the government. And actually we see as well a good development, I think, from LIA. They are really now, after the reform they have done, they're much more focused on individual cases. At the end, you need to convince each individual investor, especially the new investors which are not in Latvia. You need to convince them individually, and I think they're doing a good job at the moment, that they're really addressing concerns of each investor, and they are very different. I mean, you can't say this is one big problem we have in Latvia. There are different problems, and they have to be addressed properly, and I think LIA and Ministry of Economy is working on that as well.
And it's worth to mention that the agency responsible to keep investors happy in Latvia just gone through severe internal reform led by its newly elected director, Ieva Jāgere. During these days, she has the first anniversary in her new role. Investment and Development Agency in Latvia itself is named among the best such agencies in Europe, with a bold ambition to reach €1 billion in signed investments this year.
What Latvia does particularly well is it makes sure that its information is up to date and accurate, and it makes it available in a very accessible way. This is the most important component of our index. Almost everything else is not quite irrelevant, but if you're not getting the data correct, if the data isn't up to date, then things are going to start to go wrong very, very quickly. Latvia also performs well in its online presence. You can see behind me, Latvia is just a click away. It does very well in terms of presenting itself online as a destination for investment. Latvia also offers excellent support It has built a very good community, a community of current investors, a community of previous investors, and a community of potential investors. It's always good for potential investors to see what's gone before. And Latvia does a very good job of bringing the two groups together. If we do have criticisms for Latvia, those would be that it could be a little bit more creative in the way that it presents its information, offering a few more bespoke options for people who might want to compare metrics across various sectors. However, I would caveat that by saying that creativity must never come at the expense of data and accuracy. I also think that Latvia could do a little bit better when it comes to responding to current events. I think that there is a huge opportunity right now for Latvia to position itself as a hub for defense tech and cyber defense, particularly given that it has a border with Russia, which I think it can turn into an asset, and also, of course, because there's a war going on very close by, and Latvia is obviously one of the major countries which is helping Ukraine in its effort.
Instead of comparing ourselves to others, we should start combining our strengths, and together Estonia, Latvia, and Lithuania form a vibrant region of 7 million people, which is dynamic testbed for innovations, digital solutions, and industrial excellences that can drive and accelerate our growth. And when we tell this story with the confidence, not just to the world, but to ourselves, we stop being three small countries and we become one strong region. And this is how we need to position ourselves as one region, Baltic region, where we all can benefit from that. And yes, well, again, I can repeat, but this is not just a matter of scale, it's a matter of mindset. And currently, actually, we are already having time-to-time discussions with our Lithuanian and Estonian partners. And we are thinking and planning common events with regards to the export promotions. Well, not maybe that much about the investments, but for export promotions, definitely.
Yeah, this sounds very nice. How far these talks are? Can you reveal some more information about
We are
this
in
one?
the planning stage. We are in the planning stage. So, but
Okay.
definitely the first events will happen for sure in 2027, and we'll see what we can manage to do together in 2026.
Great. This is great news. I have myself encountered not many, but like on one hand, I can count these examples where Lithuanian and also Estonian law offices, rather, these are legal offices. They have come across some investment opportunities where big firms, they want to open something here in one of the countries, and they ask for, let's say, 1,000 or more employees. And at that point, they are denied because, of course, they don't have such amount of specialists. But if we look at the Baltic scope, then those 1,000+ employees are that's okay. And the problem is that they are not communicated further. So basically, if they are stuck in Lithuania, they're not coming to Latvia and Estonia, and this is because we don't have this common platform of either investment or export support. How do you see this? That could somehow be something that we could develop, or this is still each country looking at their each backyard?
Of course, mostly as investment agencies, we work with the greenfield projects, yes, and there, as for greenfield projects, we still look on each other as competitors. Usually, we are shortlisted or longlisted as competitors, as countries, and the investors, they are not looking as a location, as a Baltics location, but only as a definite specific country location. Yes, but when we talk about the development projects, of course, there we need to cooperate more and exchange with this information, because this is the way how we can benefit, all countries can benefit. For example, I have one example from my experience where Latvian company, they contacted me and asked for the contacts in Lithuanian investment agency, because they are considering their expansion plans. Actually, which is good also for Latvia, since the headquarters and the main office and production plant is in Latvia, and they are growing in Baltic region. So this is also the way how we can cooperate more, and also we can welcome all these contacts from Estonia and Lithuania as a one-stop agency, and we will support these companies with their expansion plans also in Latvia. This is again another opportunity for all of us. But definitely we should talk more, and we should also position ourselves as a Baltic region, because each country we have a small limited market, also target audience, but when we count together, then this is a 7 million potential customers altogether in the Baltics, with great connectivity and many other advantages we can offer.
Saudi Mega Investment Summit took place 3 weeks ago, and to my memory, it's one of the biggest gatherings of CEOs of the largest banks in the world, at least in recent years. I'm quite used to see these guys and those faces in Davos, but never in Saudi Arabia, and that speaks volumes about the region, about the capital flow to the country, and about the scale of investment taking place there right now. I want to show you just the most important cutouts from the roundtable show-off discussion.
Being the only Saudi on this roundtable, I have to say I'm very proud of the changes that has happened in the country. I think what we see around this table is an indication of how attractive the market has become in Saudi Arabia. Earlier, we heard that 24% has been the growth of investment into the country. 34 billion has been invested from foreigners in the country. But it's all because of the tremendous change that has taken place. Ease of doing business, visas are easier to get. Lifestyle has improved tremendously. But one of our biggest changes has been the new investment law, which took effect this year. And this investment law gives foreign owners and Saudi owners equal footing in the countries. So in terms of access of capital, owning real estate, disposing of their investment, and repatriating the money. That's a tremendous change.
Okay. So let's suppose I wanted to invest in Saudi Arabia, and I didn't know that much about Saudi Arabia. What areas of Saudi Arabia would you recommend that I, as an investor, put my money in now?
Well, the country is booming. Real estate, selectively, is a very good area to invest in. Technology, we are in demand of great technology. So, I should go back to retail estate. What I heard is data centers, and I think you are investing in data centers in the country, as well as healthcare. There's a great demand for quality healthcare, pharmaceuticals, and I have to say in renewable energy, as there is a great demand for increasing our output from renewable energy.
And is it easier being a woman investing in Saudi Arabia than it was 10, 20, or 30 years ago?
I've been doing business in Saudi Arabia for more than 40 years. It is more visible now, but I think it has been the same all along. There has been no discrimination between women and men from the beginning, I would have to say.
We just did a transaction here in the kingdom, and we had 5x more demand than we could provide. It was for a pipeline in Jafura, and the amount of money that was interested in investing here in the kingdom was at a record level from places all throughout the world. We had 5 times more demand for investing in this one project. To me, this is just an indication of the transformation here in the kingdom, but more importantly in the whole region. And I do believe we're seeing more and more as the GCC becoming one of the major destinations for capital. This region has been typically underinvested by global investors worldwide. At the beginning of the year, we did see some modest transformation movement out of the dollar, and we saw that money moving into Europe and to other places. But that movement was from a huge overweight in dollar-based assets. And I would say in the last 2 months, we're seeing that money coming back into the United States. And so I don't see there's that much movement. There's still a deep belief in the opportunity in the U.S. You asked Cristiano about AI. If you look at the makeup of the second quarter of the U.S. economy, over 40% of the economic growth in the second quarter was CapEx for technology. And you don't see that in other places in the world. And it's that CapEx, whether it is through data centers or finding more power, gas, building gas turbines, you're seeing all that happening more in the United States than most places in the world today.
Saudi is a reliable and a trustworthy partner, and thanks for the great work. We've got about 50,000 employees in our gold mines, and we've got investments in Australia and Papua New Guinea. Gold has always been a reliable source of wealth. We love the dollar, we love the euro, but during difficult times, the world, as has recently been reflected by the central banks, they fall back, and gold plays an important part. But as an entrepreneur, we have to diversify. So we're in 38 countries in Africa, and we invest in India, in Europe, in America. But for us, Africa is the most exciting place to be. Are there challenges in Africa? Yes. Will there be challenges? But it's an incredible place for us to invest and get competitive returns.
So about 1% of private equity dollars invested around the world are invested in Africa. Should it be a higher percentage, and why aren't people investing more in private equity dollars in Africa?
Over the last 20 to 30 years, we've tended to look at investments worldwide, and we underestimated the huge amount of capital in Africa. I mean, our businesses, family businesses, we've invested billions of dollars on the continent. We can invest in other parts of the world, but the challenge for Africa will continue to be, it has to be a globally competitive destination for investment. Investors, whether in London, New York, or any other part of the world, invest in the most competitive countries where investment is welcome, safe, competitive, and the returns are good. So I'm confident, I'm excited about the future of Africa, and we will continue investing in the continent.
David is the CEO of Goldman Sachs. David, the IPO market and the M&A market seem to be coming back. What kept it from coming back for a while, and do you think it's going to come back as well in Europe as well as in the United States?
Well, first of all, thank you. I'm delighted to be here. I want to echo the thanks to His Excellency Yasser and Richard for the opportunity to be here again. There's no question M&A and IPO activity have been accelerating. I think they'll continue to accelerate in this environment. I think there are different reasons why there were headwinds over the course of the last handful of years with respect to both. With respect to M&A, confidence and also the regulatory environment weighs. And so I think with respect to M&A, no matter where you were operating in the world, if you wanted to do large, interesting, strategic things, one of the first questions was, can we? And no matter what the question was, the answer was generally no. We're now in an environment where the question is, can we? And the answer is generally maybe to potentially yes. And so that's leading CEOs to be much more strategically focused. I think scale continues to matter enormously. And so if you have an opportunity to create scale and relative position, and right now people feel that there's a regulatory environment that will permit it, we're seeing an incredible pickup in activity, and I think that'll carry through in 26 and into 27, unless there's something that slows that down. With respect to the IPO market and also financial sponsor activity, and Scott, alluded to this, 2020 and 2021 led to significant markups in private investments, and then 2022 led to a different valuation equation, and it's just taken time for us to grow into that. We've now come close to growing into that, and that's leading to an acceleration. I think the IPO market is wide open for companies that want to bring, good businesses priced appropriately, and I think you're going to see that continue to accelerate, although in the U.S., with the government closed, there are no IPOs, so until we get the government open, it's hard to see that. The pace of this activity in Europe, for example, is slower. And it's slower because of the regulatory burdens. It's slower because of some of the headwinds. 60 to 70% of all M&A activity, the target or the acquirer are US-based. And while IPO activity is definitely accelerating around the world, the US has deeply embedded advantages where more of the activity will be US-based.
Do you have any worry about a potential recession in the United States? Do you see any evidence of that anytime soon?
I mean, I always worry about, what can happen and what will happen. At the moment, I don't see a lot of compelling evidence for an economic slowdown in the near term. But the thing about economic slowdowns that I think is important for us to all remember is there's always a distribution where that's possible. Confidence can change very quickly. Exogenous events can change that confidence. At the moment, that doesn't seem obvious in the next 6 to 12 months. But I assure you, when we do get a slowdown or we get a change, it's going to be something that we don't see coming, when it actually shows up.
The United States government has roughly, I guess now, about $38 trillion of debt, and we're adding about $2 trillion every year. Does that bother any of you that we have this much debt, or you think it's manageable because we've been managing it for the last 10 years or so? Anybody worried about the debt? You are?
Actually, I think we keep looking at the liability side of the balance sheet, and I think we also have to focus on the asset side of the balance sheet. And I think what the president is trying to do is massively increase the asset side of the balance sheet, including, among other things, I think is the investment in Intel is up 2x, 2.5x since the president made the investment. Look, I think it's very difficult to outrun $37 trillion of liabilities when the demands, it's very easy for a government elected for a relatively short period of time to make commitments. I do think the way we're going to get there is by growing the asset side of the balance sheet. And if you think about the government owns 21% of every corporation in America, and it can adjust the tax rate anytime it wants. It owns 35% of every American's income, and it can make an adjustment in that number anytime. So there are a lot of assets on the balance sheet of the U.S. government that don't appear that are significant. So I'm not worried about our solvency, although I would like to see a slower growth rate in our liabilities.
That's it for today. We see you again in 2 weeks when the new edition of MedianReport will come out. We'll be reporting from European Business Summit in Brussels, Baltic Capital Markets Conference in Riga, showing you a discussion among the 3 finance ministers. Lots of good stuff ahead. Meanwhile, I suggest you to join this channel for daily international business press review. Whatever the form, whenever you watch or listen, we will talk.
Don't forget to subscribe. And if you have already subscribed, join Median Premium Package for only $2.99 a month for exclusive content and full-length interviews. Find us also on Spotify and all the best podcasting platforms. Thank you for comments, shares, and likes. We appreciate them a lot. This has been a production by Standout.